So now let's look at one 50 marker question from our revision kit. So the question name and number is 35, McClane and Company, September 2021, amended. So this question was asked in September or December 2021. It is July 2000 and you are the audit manager, audit department of, you are in the audit department of McClane Company, a firm of chartered certified accountants. You are assigned to the audit of Gruber Company, which has a financial year ending 30th September X5. Okay, so I'm just highlighting all the numbers, all the important ones. Okay, so you need to know what is your role as well. So we are the audit manager. Okay, audit manager. Gruber Company is a new client. See, Gruber Company is a new client. Whenever you read this sentence, note it down, because when we have risk related question, but specifically in 50 marker, there will be risk related only. So whenever we have risk related question, we need to note the risk. So here new client is a risk because it will increase our detection risk. The audit firm have been appointed in January X5. The audit was previously performed by Ellis Associates. So it was done by Ellis Associates. And we have been appointed on January X5. Gruber is owned and managed by Gruber family. So it's a family owned business. Its principal operation being design and construction of bespoke machinery in the industry of oil, in the oil industry. Okay, so that's the next one. The following exhibits available on the left hand side of the screen provide information relevant to the question. So whatever exhibits that you can see here, 1, 2, 3, 4, 5, in your exam practice, it will be on the left hand side of your screen. I will show you one question from the practice platform itself, a past exam question, so that you can understand that better. But for the time being, just all these exhibits are mentioned here in the question. We can take a look at it. Generally, the partner's email would consist of all the requirements. Okay, all the requirements will be consisting in the partner's email. So these are the information that are given to us. This information should be used in the answer requirement within your chosen response. So whenever you are writing the answer, we need to mention these requirements. As you can see, total is 50 marks, of which 10 marks is professional marks. Professional marks would include skill in communication, analysis and evaluation, professional skepticism and judgment, and commercial acumen in your answer. The remaining 40 marks is for your answer, the actual answer that you gotta write. So let's first look at the respond to the instructions in an email from the engagement partner. So let's look at the response from an email from the engagement audit partner. Okay. So this is the email to audit manager from A.L. Powell, audit engagement partner. 1st July 2000 X5. Audit planning for Gruber Company. Hello, I have provided with you some information which you should use to help with planning of the audit of Gruber for the financial year ending 30th September X5. As you know, Gruber Company is a new client. The firm's client due diligence and acceptance procedures were all successfully completed. So that's done. So we have done the KYC, we have accepted the procedures, preconditions are accepted, and all those things are done. Okay. So we don't need to worry about those aspects. I require you to prepare briefing note for my own use in which, so we are supposed to write a briefing note. So we need to create a format of briefing note and write it accordingly. Discuss the matter specific in the planning of the audit engagement, which should be considered in developing the audit strategy for the Gruber Company. Okay, so we need to discuss the matters which are specific to the initial audit engagement, planning of the initial audit engagement. Second, using the information in exhibits 1, 2, 3 and 4, evaluate and prioritize significant audit risk. So prioritize on the significant audit risk in considering the planning on the completion of the company audit. Design the principal audit procedures to be performed in respect of Nakatomi building, including those relating to use an expert to provide the fair value. So the use of an expert to provide the fair value. So what are the audit procedures for Nakatomi building? Nakatomi building, it's a simple question because building is under PPE. So we just need to write the procedures for PPE. Using the information in Exhibit 5, describe the ethical issues, recommended actions to be taken by our firm. So Exhibit 5 will be used only for our ethical considerations. Exhibits 1, 2, 3 and 4, we need to use it to write our significant audit risk. So significant audit risk will be used in ethical in exhibits 1, 2, 3 and 4. One simple risk we have already got. What is that? New client. So we need to write about that. So something we need to write about that. So 21 marks, 2 marks we have already got. Let's look at exhibit number 2. The company was established 15 years ago by Martin Gruber, an engineer who had patented a new type of machine using the oil industry. So there is a patents. So patents, which means there will be intangible asset as per IAS 38 standard, will come into picture. Martin, who is the company's chief executive officer, owns 60% of the shares in the company. Okay. So Martin is a chief executive officer. He owns 60% of shares in the company, with the remainder split between the brother and the sister, Craig and Iris Gruber. The company's board of directors include Craig Gruber, a chief finance officer, Iris Gruber, marketing director, and a non-family member, Kelly Hayes, who is the director of operations. Gruber has 300 employees, most of whom are mechanical engineers. Martin is planning to sell his shares and retire from business. Okay. Craig and Chris are younger than Martin, will retain their shares and their board positions. Initial discussions with the potential acquirer of Martin shares began last month. The company owns a head office and leases a production facility where machines are being designed and assembled under the contract with individual customers. Typically, an order takes 14 months to complete. From the initial design through installation of the customer's premises. This is due to large size of the machinery being produced to customer order and the very specific requirement of the customers. Key information extracted from the management accounts. Revenue projected to 30th September X5 75 million, actual to 30th September X4 65 million. Operating profit 18 million and 10 million. Profit before tax 14 million and 9 million. Total assets 120 million and 88 million. Included in assets are intangible assets 19 million and 10 million. Notes. 1. Revenue is derived from customers involving the design, manufacture and installation of machinery to customer order. Currently, the company establishes all of its customer contracts to contain only one performance obligation: the successful installation of the machine at the customer's premises. However, around a quarter of the contracts also include a 3-year support services for the machinery installed. So revenues derived from contracts involving the design, machinery and installation of the machinery to the customer order. Okay. Currently, the company establishes all of its customer contracts to only one performance obligation: the successful installation of machine at the customer premises. However, around a quarter of the contracts also include a 3-year support service for the machinery involved. So now there is a problem with the revenue recognition. What is it? I'll give you maybe 10 seconds if you can think about it. There is some problem with the revenue recognition. I would give you just 10 seconds. Just think about it. So if you look at here, in the customer contracts, they are saying there is only one performance obligation, which is successful installation of machine premises. So the moment the machine has been installed, you're recognizing revenue. However, around a quarter of the contract also includes a 3-year support service. So the risk is that for the remaining quarter of the contract, so let's say we have 100 contracts, then around 25 contracts, which is the quarter. So 100 divided by 4 is 25 contracts. 25 contracts includes 3-year support services. So the 3-year support services, you cannot show performance obligation at the particular point in time. You have to defer it over 3-year period. So that deferred consideration should also be taken into consideration. So you need to ensure that there will be a deferred revenue, or whether the services are being paid only after 1 year is done, etc. Or if they are paying in advance. If they are paying in advance, then it has to be a deferred revenue, and revenue have to be recognized each year once the support have been completed. Operating profit includes a profit of 2.2 million relating to Argyle contract, details of which are given in exhibit number 4. This is the full amount of profit estimated to be made on the contract. The company CFO suggests that while the company's accounting policy is to use the output method to determine the completion stage of a contract at year end, it is to operate to recognize the full amount of profit on the contract because the customer has paid in advance. So the customer has paid in advance. So here, if you look at here, there includes a profit of 2.2 million in the Argyle contract. The full amount of profit estimated to be made on the contract, the company CFO suggests that while the accounting policy is to use output method, it is appropriate to recognize full amount of profit. Again, This is again a problem because it's not allowed to use full amount of profit of contract even though the customer have paid in advance. So customer, if they have paid in advance, then it will be a obligation for them to do it, right? So there will be again a deferred revenue that they have to create, or there will be a contract obligation, not a contract asset. So they have to account it as a contract asset or a contract obligation. Here, since the customer have already paid everything in advance, then it will be contract obligation. Now they are the company is now under obligation to complete the contract, but only the profits can be recognized after the contract has been completed, and the profits have to be accrued over the period of time. It cannot be all the profits cannot be accrued in single year itself. Operating profit also includes a loss of 700,000 relating to Johnson's contracts. Details are given in exhibit number 4. This loss is determined based on the estimated loss of 840 prorated over number of months completed on the contract by 30th September 2005. Now here there is a serious problem with respect to this P&L profit or loss, how they are charging it. See, there is a concept called as prudence concept. As per the prudence concept for IFRS, all the estimated losses have to be recognized immediately in full, whereas any profits have to be recognized over the prorated number of months. They cannot, or the company cannot recognize the entire profit until and unless they are virtually certain to receive it. So here the profits have to be prorated based on the number of months of the output method which they are using based on the completion of the contract. Relating to the losses, entire 840,000 have to be recognized. So that is a clear risk. It's not a risk, it's a misstatement. If they are doing it, then it's a misstatement. There is a clear risk of misstatement, material misstatement. Profit before tax included an estimated increase in the fair value of the Nakatomi building, investment property of $2 million. Details are provided about this investment in exhibit number 4. So we have a Nakatomi building which they have already mentioned. Let me just very quickly see that where else they have mentioned about the building. We read this in exhibit number 1 that we need to perform principal audit procedures with respect to Nakatomi building. So now from here we have understood that Nakatomi building is an investment property. It's not a property, plant and equipment. It's IAS 40 investment property. So the evidences and the procedures have to be in line with the IAS 40 investment property. The change in the value of intangible assets represents a transaction which took place in March 2005, whereby Gruber purchased some designs from Martin Gruber for $9 million. The value of this transaction was determined by Martin Gruber. The audit engagement partner has asked for information to support this value, but nothing has been received yet from Martin. So what is the problem here? Who is Martin Gruber? First understand that. Whenever you see a name, understand the relationship of that name of that person with the company. Who is Martin Gruber now? If you look at here, who is Martin Gruber? So look at here. Martin Gruber is the company's CEO, isn't it? He is the chief executive officer and he has 60% of shares in the company, which makes him a critical shareholder. Now this shareholder has a transaction with the company with respect to an intangible asset, the value which he is saying it's $9 million. So designs which is purchased by the company, Gruber company, from Martin Gruber, who's the CEO, for $9 million, and he's the CEO of the company. Firstly, there is a confusion here. If he is the CEO of the company, why is he involving with the transaction with the company where his designs are purchased from him? Why can't he simply design those directly for the Gruber company and take a salary? Why it should be in such a way that there are certain designs and those intangible assets which he has created for his personal purposes, and intangible assets, the value which he has decided the company is buying. There is something, for me, it's like a red flag. It's like a red flag, and he himself wants to exit from the company. So is he trying to divert funds from the company to his personal properties? That's a big question mark or a red flag. Second, this is a related party transaction. So the disclosure with respect to the related party investigation related to with respect to related party, everything have to be mentioned in a detailed way. And we need those informations because this is completely a red flag for us. Exhibit 4, Argyle contract. In October 2004, Gruber entered into a significant contract to design, construct and install a large piece of machinery for a new customer, Argyle Company. In October 2004, it was estimated that the design and construction of the new machine would take 15 months, with the installation estimated to take place in January 2006. The agreed price of the machine is 6 million and Gruber Company will have incurred cost of 2.6 million to this contract by 30th September X5. Based on the project plans, the estimated value of the work certified at 30th September X5 is 4 million. Okay. And the estimated cost to complete is 1.2 million. As noted in Exhibit 3, the operating profit includes a profit of 2.2 million in relation to the Argyle contract. Okay. So if you look at here, we entered into a contract on 1st October X4. Okay. And it took around 15 months to complete for the installation to take place. Okay. It was estimated that it would take 15 months. With the installation to take place in January X6. So installation might take place in January 2006. The agreed price of the machine is 6 million. And Gruber Co. will have an incurred cost of 2.6 million. In relation to this contract by 30th September, based on the project plans, the estimated value of the work certified 30th September X5 is 4 million. And the estimated cost to complete is 1.2 million. As noted in Exhibit 3, a profit includes a total profit of 2.2 million. So this is an estimated value. We have to use the, whatever the revenue is multiplied by what is the work that have been completed till the year end for 31st September 2005. What is the work that have been completed? Okay. And based on that, we need to calculate what is the cost, and from the cost we need to arrive, at the profit. So that's how we need to take it into consideration. So if you look at here, total cost incurred is 2.6 million. So if your revenue is 4 million, then 4 minus 2.6 have to be used. In that case itself, 2.2 profit is not appropriate. So we need to be very careful about this. The next question is Johnson contract. On 1st December, Gruber entered into a contract with Johnson to design, construction and install a machine. The contract, which will take 12 months to complete, was initially projected to make a profit of 2.8 million. However, due to cost inflation, errors have been made in the initial project. The contract is now estimated to make a loss of $840,000. So this loss entirety have to be recognized. Investment property. In 2004, the following completion of significant contract, the company purchased an investment property in Nakatomi building for $15 million. The property is a retail development in the country's capital city. The company is going to appoint an expert to provide a valuation which is having an initial estimate increase of $2 million. Included in the company's financial projection to 30th September X5. So now what is the problem here? It's an estimation. Right? So it's an estimation. And in terms of estimation, you are creating that fair value increase. No, that's not appropriate. The property valuation have to be completed, and only after the valuation of fair value we can show a 2 million 2 million fair value increase. And their company is going to appoint an expert. Now can we use that expert in our audit? Yes, we can. We can use the expert's valuation in our audit, provided he is competent, he is competent enough, he is independent, and all his estimations have been reviewed by the auditor. Exhibit 5. A meeting took place yesterday in which the audit engagement partner discussed the potential sale of Martin Gruber's shares with the company. The company's director revealed that Will's company is with whom negotiations have started in relation to the sale of Martin Gruber's shares. Will's is an existing audit client of McClane & Co. The directors have requested that McClane & Co. assist them by performing vendors' due diligence services in which they would conduct an independent review of Gruber's financial position and future prospects and produce a report on their findings to be provided to Willis Company. So since now we have highlighted all the pointers, let's now write down the answers. So the first question is, discuss the matters which are specific to the planning of initial audit engagement which should be considered in developing the audit strategy. So let's start with that first. I'm just going to write the pointers for this particular question because it's something which is coming from your textbook as well, but the only thing is that you need to relate it to the answer. So I will try to relate it to the scenario, but it's for 5 marks. So it's 5 marks means you know how much deep you need to write. So if it is something more than 3 to 4 marks and coming around 5 marks or more, then you might have to consider writing at least 3 to 4 paragraphs, and in that you have to go deeper, mentioning all the pointers. So I will be explaining all the pointers. I'll just mention the pointers in a short format, but during the exam please write it in a detailed manner and try to include further pointers from the scenario. So our requirement itself is to actually write a briefing note. So when it comes to briefing note, our format have to be very clear. So the briefing note format, you can start with briefing notes. You can start with the letter. It's kind of a letter format. So first mention the heading briefing note to audit engagement partner from audit manager. Subject. What is the subject? It's an email kind of a format or a letter kind of a format. Gruber Company Audit Planning. This is the subject. Then you start with the introduction. What is the introduction you start with? You can mention that these briefing notes are prepared to assist with the planning the audit of Gruber Company for the financial year ending 30th September 2000X5. The notes begin with discussing. Now you can write all the requirements. Discussing the implications of initial audit engagements, and then move to so you can read the requirements. So evaluate and prioritize. So you can directly write it from the requirement itself. So evaluate and prioritize significant audit risks which should be considered in planning of the audit. Okay. The notes also you can write recommend the audit procedures to be performed in relation to investment property. Finally, the notes address the ethical issues arising from a meeting with the company's management team. So these are the requirements that we are supposed to write. So all you need to do is in the introduction, it's very simple. So this briefing note is for what? Is for 4 things. Planning to assist with the audit, planning of the audit. Then you can write all the requirements, just club it into one sentence and write it. That's it. And then we can immediately write the first requirement, write about the first requirement, which is A, planning of initial audit engagement. That's all. The planning of initial audit engagement, we can write it. So I'm now going to explain each of them. So this is the format of the briefing note. Just take into consideration the format. Once we have written all the answers, then we will give a conclusion to the briefing note as well. These particular briefing note formats are very important. because otherwise you will lose marks. So you lose marks. Professional marks, if you want to gain, the format is very important. So create this format, and then I can also share it along with the app. So you can download it and you can use that to create it your format. But whenever you're practicing, ensure that you're practicing along with the briefing notes. So this is an initial audit engagement. So when it comes to initial audit engagement, what are the matters that is specific to planning of an initial audit engagement? This is the question. So the first and foremost is that if you can remember the standard name, then number and name, then mention that. So you can write this by starting that in an initial audit engagement. There are several factors that should be considered for planning procedures which are carried out for every audit as per the ACCA 300 planning and audit of financial statements. Okay, now we have mentioned the standards and all those things. So the next pointer we need to write is will be in relation to this only. So let's look at that. So in this case, ACCA 300, what do they suggest? ACCA 300 says that unless and until it's provided by law, all the details, the company, before they accept any initial engagement client, they have to obtain pre-clearance, and all the details of the previous year audit working papers have to be obtained from the previous auditor. So I'm gonna write it here, previous auditor. So I'm just putting it as a pointer for you. You don't need to write this paragraph, so that it's when I'm explaining this or when I'm writing this sentences, it will be clear to you. So you can say as per ACCA 300, McClane and company should obtain professional clearance from Gruber company's previous auditors. And who are they? Ellis Associates. Any matters which were brought to the attention of McClane company when professional clearance were obtained should be considered for potential impact of the audit strategy. Okay, so this is the first thing that we need to understand and mention it. So we should have obtained professional clearance, and the professional clearance, any matters that were considered during the professional clearance should have been discussed and considered for the impact of the audit strategy. Okay, the next one is that McClane and Co should make arrangements with Ellis Associates to review their working papers. Alright, so communication should be made with Ellis Associates to request access to their working papers for financial year ended 30th September 2000X4. So, and why this will help? This because this will help to highlight certain issues which have been there in the previous year, and whether those issues are continuing in the current year. It will help us to identify whether the accounting policy have been followed consistently and whether appropriate accounting policies have been followed. Further, whether the opening balances have certain issues or not. Okay. This will also help us to provide information relating the company and their related party, transactions, etc. Okay. Further, we need to get the previous prior year audit report as well. So the prior year audit report should be reviewed and consider if the reports were modified, and if so, the reason for the modification. Okay, so these are the considerations that you need to do when it comes to the previous auditor. Okay, so the second one is discussion with the management. Okay, discussion with the management. So in that you should write there should be considerations of matters which were discussed with Gruber Company's management in connection with the appointment of McClane and Co. as auditors. The audit team should consider any major issues which have been discussed with the management at initial meetings and how these will impact the audit strategy and plan. So what are the matters that were considered in connection with the management, and during the meeting with the management, have they considered certain major issues with respect to the accounting and treatment of certain items, and how they will impact the audit strategy and plan. For example, we can say the accounting treatment in relation to the construction contracts may have been discussed as this is a significant accounting policy. Okay, so this is the next one. So you can write this particular question into parts, like whatever we are discussing with the previous auditor, whatever your discussions with the management, etc. Then you can look at other factors, which is audit of opening balances. Audit of opening balances. Okay, so as per ISA 510, procedures are required to be performed by the auditors to determine whether the opening balances reflect the application of appropriate accounting policies and determine whether the prior periods closing have been correctly brought forward into the current period or not. So that's the responsibility we do when it comes to audit of the opening balances. Then there are a few things that we need to consider is our quality management and understanding the entity. So you can write about understanding the business and the industry. So in this you can deeply explain, like that how the auditor should develop an understanding of the business, okay, including legal and regulatory framework. Okay, Then it will be also important to gain an understanding of the legal and regulatory issues within or specific within the oil industry, such as health and safety, environmental legislation, etc. Okay. We should also develop a the audit team should focus on audit team should perform analytical procedures and develop appropriate audit strategy. So they should develop analytical procedures and develop appropriate audit strategy. Okay. In relation to the accounting of the customers contracts, they should also, for example, in the case of bespoke contracts they need to check whether there is a valuation of inventory, whether work should be done, etc. So they need to go through review specific accounting related items and create a strategy for the review of the accounting of those transactions. Example, whether example, valuation in relation to inventory or work in progress, etc. And the last one is about quality management. So quality management, and in this we can specifically explain in case of quality initial engagements, there has to be whether consideration should be given consideration if an independent review independent partner review is required for the audit. Okay, that has to be given for cover consideration, whether you need a independent partner review, etc. And you need to consider the involvement, whether involvement of senior partners or another individual for overall audit strategy and overall strategy prior to commencing the audit. So we need to review if Gruber is required for any compulsory independent reviews. Okay, and such compulsory issues should be documented as well, documented clearly. Okay, this is the next one. Now the last one is to consider, since it's a new client, other risk factors have to be discussed in briefing notes when developing the audit strategy consideration, audit strategy consideration, and further consideration, audit strategy and additional consideration should be given to reduce detection risk. These are the few things that you need to go through. Okay, so since we know this, now let's go to the next question, which is to prepare the significant audit risk. So we'll need to prepare a significant audit risk. So now let's look at the next question, which is question number B. Question number B. audit risk evaluation and prioritization. Audit risk evaluation and prioritization. So in this point we have to write down what are the various audit risks that we would have, and we need to provide a possible explanation of why it is a risk. So you need to have a deeper explanation relating to the standards or relating to the auditing rules and regulations itself, why that particular risk is going to affect us. So the first risk that we are going to write is about new client. So when the audit client is a new client, then definitely it increases the deduction risk. So this is the first year in which McClane and Co has audited the company, which increases the deduction risk as our firm have no previous experience with the client. Okay, the client. This could lead to a risk or difficulties to detect material misstatements. And how can we reduce it? So that's what is the risk. Now why are we consider it as a risk, right? Why are we considering it as a risk? That we need to explain. And how do we reduce it? That also we need to explain. So we are gonna write, in order to mitigate this risk, McClane needs to perform rigorous audit planning, including obtaining a thorough understanding of the business of the company. Understanding of the business of the company. Okay. We have already mentioned a few detection risk in our part A, so we can refer to that and then mention it very clearly. Okay, we can mention it very clearly by linking to part A answers that we have already mentioned. Like for example, testing of opening balances are few things that we have already mentioned in part A. So we just need to link that and write it as well in this particular risk. So in addition, as discussed in part A, there is a risk that opening balances and comparative information may be incorrect compared to the prior year, as they were not audited by McClane and Co. Therefore, it is important that McClane and Co. plan the audit of opening balances carefully in accordance as per, I will put it as carefully as per ISA 510 to ensure opening balances and comparative information are free from material misstatements. Okay, they both are free from material misstatement. Okay, so further, McClane and Co. will need to communicate with LS Associates to arrange to review their files to identify any potential issues with the prior year audits. Okay. Particularly any disagreements, integrity issues or management biasness noted, etc. These are the things that we need to consider. Okay, these are things that we need to consider. So as you can see how deep we are writing. When it comes to AA, we just write it as a, it's a new client, and there could be increase in detection risk, and hence there could be material misstatements the auditor did not identify. So therefore we need to establish a senior team, we need to review the opening balances, etc. No, but we have to write it in a detailed manner in when it comes to AAA. We have to write it in a deeper manner. Alright, the next one is we can write it as management bias. Okay, management bias. Now in this situation, what is management bias all about? If you look at here, the CEO, which is Gruber, Martin Gruber, is planning to sell his stake of 60% shares from this company. Now when that case is there, he wants to ensure that there is someone who buys his entire portfolio. Like, so the shares in the company, his shares, there will be someone who will be ready to buy. Now there is a potential acquirer for this Martin share, which the discussion began last month. So now there could be a situation where the company, the Gruber company, which is a family owned business, wants to overstate the assets, revenue, etc. to ensure that the potential buyer do buy this company, or even if he's not there, anyone else would buy this company because the company is looking good. So there would be the integrity of the management could be questioned here, where management will have intentions to purposely show or overstate the assets and revenues of the company and reduce the liability of the company, and the profits they would like to maximize it, which was evident from certain risk that we looked at. For example, the contract revenue or the contract profit from Algar contract and other Johnson contract. It is very evident that they want to increase the profit and reduce the losses. And even the revenue recognition of the services which are combined along with the successful installation of the machine all shows that they want to inflate the revenue. Even intangible assets they would like to inflate it, whereby they are they are buying it directly from Martin Gruber at a price which is fixed by him, where he could have provided the services for just a salary. So all those shows that the assets are completely inflated, so that they can potentially show the value of the assets as higher and sell the shares of the company very easily. So we need to write in such a way that the explanation is very clear to the examiner what we are trying to convey. Here we are trying to convey that the major shareholder is planning to sell his shares, and there has been an initial discussion already with the potential purchaser. This situation means that there is biasness, that Martin will want to maximize his sell price. Therefore, he will try to overstate the profits, revenue and assets of the company to show it in a good position. And since it's a family owned business, Martin can override the financial reporting and put pressure on the CFO, who is just his brother, to manipulate the financial statement. Further, there are various other assets, various other items which are discussed, which could possibly indicate management biasness, like the accounting treatment of revenue, valuation of investment property, measurement of intangible assets, etc. So that's what we are going to write. So the company's major shareholder, Martin Gruber. So this one I'm taking directly from the scenario. It's directly mentioned here. I'm just using that. Is planning to sell his shares and retire from the business. There have been initial discussions with a potential acquirer for Martin's shares began last month. Alright, so this means that there is a risk of management bias that Martin will want to maximize the sale price, and for this reason there is a risk that assets will be overstated and revenue and profitability will be maximized, as he will want the company's financial statements to reflect as good as a financial position and performance as possible. Okay, so this is what we are trying to write. So he has an intention to sell his company, so which means he wants to increase the value of the company as much as possible. Further, since Martin's brother is the CFO, it will be easier for Martin to override the controls of financial reporting and put pressure on his brother to manipulate the financial statements. Several risks discussed below would indicate the management bias have been applied, in particular in contract profits of Argyle and Johnson, revenue recognition, investment valuation of investment property, and measurement of intangible assets. Okay, so these are the things which we need to write it in management bias. Okay, so the next one that we are going to talk about is, so now let's look at the next one, which is analytical procedures. So whenever you are given key information extracted from the management accounts, you are required to explain about the analytical procedures, because only then you will score marks. Okay, so always remember this, that if they are giving you certain numbers, revenue, profit, assets numbers, they are asking you to write the analytical procedures. Okay, what do you expect or what do you identify from the analytical procedures is what they are trying to ask here. So we can say that as based on the analytical procedures of the financial statements shows that one, okay, revenue is projected to increase by how much? 75 minus 65. So we need to calculate that. So let's use a calculator. Okay, so 75 minus 65 is 10. So 10 divided by 65 into 100. So 15 percentage. So revenue is projected to increase by 15.3 percentage. And then B, if you look at the next one, that is operating profit is increased by 8. So 8 divided by 10 into 100. So that is 80%. So operating profit is expected to increase by 80%. And then profit before tax, so that is 14 minus 9 is 5 divided by 9 is 55%. So profit before tax is expected to increase by 55%. So these are the three things, right? So now this is a red flag. Particularly when I look at this is a red flag. Why? Because when we read all these exhibits or notes, we understood that there has been some overstatement of revenue. There has been some critical overstatement of profit and operating profit based on the contracts that we identified. So this is something that they are showing it as a red flag. Further, when revenue is increasing only by 15, how do you expect to increase the operating profit also by 80%? What is the increase from 8 million relates to? Right, so what is the 8 million relates to? So if it is increasing by 15%, so 10 into 15% is 1.5. So it should have increased to 11.5 only. Operating profit should have increased to 11.5. Then it makes sense because revenue has increased by 15%. Operating profit has also increased by 15 to 16%. Okay, fine. But operating profit increasing by 80%, where does the remaining amount comes from? If it is not revenue, where it comes from? We need to get those explanations. So that's what we are going to ask. They are projecting these numbers, that's fine. But for that, we need to have relevant explanations. The auditor should be alert to the possibilities that revenue and profits could be deliberately overstated, considering Martin Gruber has an incentive for the financial statements to be incentive to, I will just edit it, for incentive to overstate the performance of the financial statements of Gruber company. Okay, so because of that, he has this incentive, so hence we need to be careful about it. Now there could be genuine reasons why the reasons and explanations for these changes. Okay, for these changes. However, management will need to provide appropriate explanation and corroboratory evidence to support these projections. Appropriate and corroboratory evidence to support these projections. That's very important. So that's what from the analytical procedures we are showing. The operating and profit before tax is expected to increase substantially compared to increase in revenue, which do not sync in line. So that is something that we need to be aware of. Okay, that is something that we are aware of. Okay, so yeah. Now then, we have written about three things that is general in nature about the entire company. Now we can go to specific transactions. The first one is revenue. So revenue, we are going to split it. Okay, revenue, we are going to split it. First one in revenue, we are going to write about the support services. Okay, we are going to write about the support services. What is the support services I am referring to? I am referring to this particular part, what is mentioned. That is the support services I am talking about. Right. So where there is around one quarter of the contracts include the 3-year support services and they seem to be combined. So that's what we are going to write about. So let's see how we are going to explain about the accounting treatment of the support services. So we need to explain the accounting treatment and regarding the performance obligation being satisfied and what is the risk related to the revenue for these support services, etc. in a very deep way. So here first let's explain what is the issue here. You can say that the company sells one quarter of the contract which includes a 3-year support services, but they are but I would put it as but the performance obligation are not established separately, rather combined with one performance obligation. Combined with one single performance obligation. So here there is a risk that the revenue related to these contracts are not separately identified into parts as required by IFRS 15. So we have explained that okay, it's not separated out, but rather they are combined together as one single performance obligations. They are one single performance obligations. They are not separately, but rather combined with one single performance obligation. Okay, that's what we are trying to write here. Now we need to explain the standard. So as per IFRS 15, the performance obligations have to be separately identified, and where contract has multiple performance obligations, then the revenue should be allocated to the performance obligations in the contract by reference to their relative standalone selling prices. So here what we need to do is what we are trying to mention is that as per IFRS 15, firstly each performance obligation have to be separately identified, and the revenue should also be allocated to each of the performance obligation based on their standalone selling prices. So here support services have a standalone selling price, installation have a standalone selling price, right? So we need to identify the support services standalone selling price, and that 3-year support services have to be considered as a separate performance obligation rather than combining it one. So here the standalone 3-year support services should be identified as separate performance obligation, even though the start of the services and installation of the machine are the same date. So just because we are saying okay, we are the start of the services and installation of the machine are the same date, we cannot say that okay, they both are combined. No, here the installation is separate, this will have to be separate. So hence there is an audit risk that Gruber company is not separating, okay, I'll put it as separating the contract revenue between the support services and installation of the machines. This could result in overstatement of revenue relating to support services being recognized together along with the rest of the revenue. Okay, and you need to also mention the standard that the support services revenue will have to be satisfied over the period of 3 years by allocating the revenue each year based on the completion of the services. Okay, this is how we need to write it. This is how we need to explain the same. Okay, so we need to first explain what is the risk. Okay, then what is the standard, what explanation can we give from the standard or the accounting treatment, and then identify why it is considered as a risk. That's what we are supposed to write. They have not asked us to mention the responses. We are only required to write what and why. What is a risk and why do you consider it as a risk? And you need to conclude each point that there is an audit risk here, mentioning what is a risk and why you consider it as a risk, like mentioning overstatement of revenue, understatement of this, liability, expenses, all those things you have to be very clear. Only then the risk question will become complete. Now the next type of issue that we have is recognition of revenue relating to Argyle contract. Okay, so revenue recognition relating to Argyle contract. So here when it comes to Argyle contract, what is the CFO suggesting? CFO suggesting that the full profit should be recognized as the customer has paid in advance. No. Firstly, if the customer has paid in advance, then it has to be, even though the customer has paid the entire money as advance, the revenue have to be broken out based on the performance obligation being satisfied. And the performance obligation on a contract related revenue can be identified using output method and input method. And identify how much have been completed based on the methods, and the revenue should be allocated only to the extent of how much the performance obligation have been completed. So which means whatever the revenue is that we are suggesting, which is to the date, based on the output method, that only we can recognize. We cannot recognize the entire full profit, which is not appropriate. And we need to check also whether this 2.2 million of profit which has been recognized is material or not. Only then, we need to consider the treatment, because if it is not material, then we can still, to an extent, try to, adjust. But if it is material, then we need to ask the client to rectify, and there is an indication of management bias, as I've been telling. So that also we need to mention very clearly. So in this, only thing is that we don't know what is a policy that have been followed, because it's the CFO suggesting that the entire profit should be recognized. But we don't know whether what is the correct accounting policy. So we need to conclude saying that we need to review the accounting policy whether it is in line as per IFRS 50. So first let's quote the CFO's wrong. So the CFO's suggestion that all amounts of profits can be recognized this year in respect of this contract is incorrect. Okay, incorrect as per IFRS 15. Okay. Further, the prudence, you can write the prudence concept explains that any losses have to be recognized in full, whereas gains should be recognized only when virtually certain. So this is something that we need to be very clear about. Okay, so you can then quote that as per IFRS 50 states that, so okay, since you're writing as per, you don't need to mention that. IFRS 15, appropriate methods are required to use. Methods are required to be used while measuring the progress of any contract revenue satisfied over the period of time. As per period of time. So the performance obligation in the contract include output and input methods which are based on determining the stage of completion of performance obligation in reference to the value of the customer goods. Okay, I don't want to write that. Okay, so the performance obligation in the contract include both output method and input method, which can be used based upon the determining which can be used to determine the stage of completion of the performance obligation. Okay, the stage of completion on the performance obligation. You can also maybe write based on the value of the goods or services transferred in compared to the remaining goods or services value to be value promised under the contract, and this is output method. Or on the basis of inputs added to the completion of performance obligation, like cost incurred, total cost incurred to compare to cost to the date, which are input method. Okay, so as per the Gruber and Company's accounting policy is to use the output method, which is this output method to calculate the stage of completion, which is based on the work certified. So you can write that the projected revenue till 30th September XY is $4 million compared to the contract price of $6 million, okay, which are mentioned in exhibit 4. Okay, so 6 million, so which means giving a percentage completion of around 67%. Okay, so around 67%. Therefore Gruber company can recognize revenue to the extent of only $4 million and a corresponding profits of so 67 into 67%. Okay, total profit is how much? Total profit will be 2.2 million, right? So 6 million minus 2.6 minus 1.2, so 2.2 million profit. So 2.2 into 67%, so that will be 1.4. so to the extent of only 1.44 million, so what was it, 1.47 million, which is, that is $2.2 to 2.2 million into 67%. Okay, $2.2 into 67%, which leads to the profits being overstated by how much? 2.2 minus 1.47, which is $0.73 million. That is 2.2 minus 1.47. Alright, and we need to check whether this is material. So whether this $730,000 is material. So how would we check that? We can compare against the profits. So 730,000 divided by 14 million, right? So 14 million, yeah, into 100, so 5.2%. So which means it represents 5.2%, which means it is material amount, because we choose a materiality of 5% to 10% of the profit. So which means, so the profit, the overstatement of $730,000 is 5.2% of the profit before tax, hence the amount, hence it is a material misstatement. The accounting treatment could also indicate the management bias as their desire to overstate the profits. All right, so we are not saying that okay, they have done this, we are saying that they could do it. So hence we need to mention by concluding that the audit team should consider whether correct accounting treatment have been applied to the contract and whether any further material misstatements regarding the same have been identified or not. So audit team should be, I would put it as audit team should be watchful of this contract revenue and should further review all other contracts in detail to consider whether correct treatment have been applied. Okay, I'll write it like that. So what we are suggesting is that the CFO suggested something wrong, and as per the standard it is wrong, and this is how the correct way we need to do it. And hence if they continue to do the wrong transaction, then it will lead to a material misstatement. And hence, as an auditor, we need to be watchful of this particular fact. This is what we are trying to identify here. That's what we are trying to mention it here. So this is how we need to explain. The next one is the similar contract, but that is Johnson one. So Johnson contract, which seems to be an onerous contract. Why? Because if you read it, entered into a contract with Johnson to design and install a machine. The contract, which will take 12 months to complete as the initial project profit. However, due to cost inflation and errors made the initial project budget, the contract is now estimated to make a loss. So hence they cannot exit also. So if they are going to continue with the contract, then two things. One is that the losses should be recognized, and this cannot be splitted. So hence the entire loss of 840,000 have to be recognized. And what is the material of that compared to the profit before tax? How much percentage 840 is compared to profit before tax? That you need to state. And whether these are expected to be a loss-breaking contract, then whether this will be an onerous contract as per IAS 37 is something that we need to consider. Because as per IAS 37, it says that any contract which we cannot default, where we have to fulfill, and which means a provision have to be created for the unavoidable cost, meeting the obligations, unavoidable cost compared to the benefits that we might generate based on the contract. All right. So this is also could be seen as a treatment of a management bias, because when they are trying to reduce the losses by prorating it compared to 2 years, so that should be considered. So there is a risk of cost inflation, as well as budgeting errors could have happened, making the contract to become loss making. So the budgets and the contract working should be detailedly reviewed. Further, this may mean that the onerous contract exists and more losses may not be recognized, leading to further risk of profit or profits being overstated. So what we are trying to identify here is that because of this one contract, we cannot say that because of this one contract is at loss, we cannot say that this is the only contract which is at loss. There could be other contracts also which could be at loss, but the company did not recognize. So 3 to 4 things which are included in this is that firstly, the treatment is incorrect. Losses should be recognized in full, and this amount is material. Second, whether the contract is an onerous contract as per IAS 37. If yes, as per IAS 37, what should be the accounting treatment for that, or what amount should be provided for, what should be the liability, etc. And if it is a IAS 37 standards follow, then the provision and the statement of financial position and the provision expenses and liability are understated, which means the liability and expenses have to be recognized. The third one is there is a management biasness, which is indicating it. Fourth one is there are errors in calculating the budgets. There could be errors in calculating budget, which has to be reviewed. And finally, the fifth one is that there could be further contracts which could be under loss, which are not recognized or identified. So these are the few things that we need to mention. So let's try to explain this answer. So we can say that the projected profit for 30th September 2000 XY includes a loss relating to Johnson contract. Okay. As per IFRS 15 and the prudence concept, any losses from the contract revenue should be recognized in full immediately and cannot apply a proration of loss over time. Okay, so that's what they are saying. So you cannot prorate the loss, but it should be recognized in full. So you can say that the loss of contract is estimated to be $840,000 and is material as it represents 6% of profit before tax. So it represents 6% of the profit before tax, and it is something, it is material as well. So you can also say that since there is a loss, IAS 37 should also be considered. So where any contract is estimated to be loss making, they should be accounted as onerous contract as per IAS 37 provisions, contingent liabilities and contingent assets. Alright, so and what does this treatment say? As per IAS 37, an onerous contract, you should recognize the measurement should be based on the unavoidable cost of fulfilling the contract. So as per IAS 37, provision should be measured based on the unavoidable cost of fulfilling the contractual obligations. Okay. Further, from this information provided, there is no possibility to determine the exact amount which should be provided, but recognizing the loss over the time is not appropriate. Right? Hence the loss recognized and provision is understated in statement of profit or loss and statement of financial position. Okay. All right. Okay, so that's what it is. All right. Okay, further, this should be considered as a signal of management bias. The accounting treatment applied reduces the loss recognized within the profit for the year and could be indication of earnings management applied in preparation of financial statements. Okay. Further, there is also a risk that the cost of inflation and budgeting errors have been incorrectly calculated to become loss making, and auditors need to review these workings in detail to ensure the contract is indeed a loss making one. Alright, and then so that also we have mentioned, and then finally we should also mention that there could be other onerous contracts existing which are unidentified by the management, providing leading to a risk of overstatement of profits for the year. Right, so leading to an overstatement of profits for the year. Okay, so these are the ones which could be the problem ones. Okay. Then, so we are done with the revenue part. Now the exhibit number 4, the other one we can easily identify is the investment property. The problem with respect to the investment property, and here the IAS 40 standard is considered, and the fair value should be considered, as well as when there is an investment property we can consider the use of an auditor expert if necessary. So the next one is investment property. So let's talk about investment property. Investment property. So what was the problem with investment property? The investment property, the problem there is not relating to the treatment, because the treatment is correct. So the investment property that they purchased, they are using it a fair value model to value, and as per IAS 40, fair value can be used, and entity can choose between the fair value and the cost model to measure the investment property. But when the fair value model is used, then the changes to the fair value should be included in profit or loss for the period in which arises. So that's also they are using it. But the problem here is the value of that particular fair valuation. They purchased it for 15 million. Now the fair value increases 2 million. So that seems to be a bit confusing, which is in less than 1 year, the valuation have increased by, the value of the building have increased by 2 million, which doesn't seem to be, appropriate. And management bias could also be included here, where they want to manipulate the profit. Further, this is a valuation is not yet performed, and it's based on an is based on an estimation, and so they might be using it to deliberately increase the revenue and deliberately increase the profit, etc. So here you can say that the investment in Nakatomi building of $15 million is material, representing how much percentage? So 15 divided by total asset is 120 million divided by 120 is around 12.5%, representing 12.5% of total assets. Further, the change in the fair value which is recognized within the profit is also material at how much? So the change in fair value is 2 million compared to profit is 14 million. So that is around 14% at 14.3% of profit before tax. Okay, so that's what the next one. So it is appropriate that the property is measured at fair value and the gain is recognized within profit. This is in accordance okay, I don't want to write that. As per IAS 40, entity is allowed to choose between the fair value model and cost model for measurement of investment properties. Okay, where fair value model is chosen, any gain or loss arising from the fair value movement should be recognized in the profit or loss for the period in which it arises. Okay. However, there is an audit risk compared to the size of the fair value gain which has been recognized. The property, okay, was only purchased at the beginning of the financial year, and an increase of 13.3%, okay, in a 12-month is considered to be significant. Okay. Further, the valuation of the property by the expert is yet to be determined. So the fair value increase included could be considered an attempt to boost the profits for the year by the management. Okay, so you should also consider that there is a level of subjectivity to determine the fair value increases, and this could lead to risk of material misstatements. Further, Gruber may hire an expert known to them to deliberately manipulate the profits and revenue. Therefore, the objectivity of the expert will be at risk. Okay. To boost the profits. Okay, so this could be considered as an attempt to boost the profits for the year by the management, and hence this will again form part of the management bias as well. Okay. Then we can also mention that the auditor should also consider whether to use an audit expert, to use his own independent audit expert to calculate the valuation of the building, considering an involvement of management bias. Okay, so this is how we write the entire explanation. So now we have just two more to go. The next one will be our intangible asset. So what is the problem with intangible assets? Like everything is problem. The intangible assets have a cost to the company of 9 million, and this is being purchased from the major shareholder, which is the Martin Gruber and the chief executive officer, and hence it will become a related party transaction. But here the question is the risk related to the management bias. Like Martin wants to sell his shares, so he wants to firstly make money from the company. It could be that he wants to make money from the company. Further, by buying it from him, it could be an attempt to windrow risk that the financial statements are maximized where you are using you are using an asset, showing it as an asset and increasing the asset, and he also wants to remove the funds as a way, so that without having him paying dividends to him, rather him paying dividends to him, he's showing it as if he has sold some designs and got some money out of the business. So here there is a indication of fraud and deliberate manipulation, and hence robust audit procedures will have to be designed. This could be relate to some intellectual property. So the existence and valuation of the asset should be supported by Martin to say how he is coming up with the value of 9 million. So this, if he does not have valid evidences, then it could be considered to be a fraud, and additional professional and high professional skepticism have to be maintained. Okay, so it's very important. So let's write about intangible asset. Okay, so the intangible asset recognized in the year at cost to the company at $9 million is material to statement of financial position, as it represents 7.5% of the total assets. It is also material by nature, as it is a transaction between the company and its major shareholder and chief executive officer, making it a related party transaction. Okay, so there is a management bias relating to this transaction. Okay, given that Martin is planning to sell his shares, there is significant risk that the transaction is an attempt to maximize the value of statement of financial, maximize the value of asset and increase the value of increase the share value of his shares, which he plans to sell. Further, Martin could have also used this transaction to withdraw funds from the company without showing dividends. Okay, so without showing dividends, he would have shown it as, okay, he's selling the intangible asset and taking the money from the company. So that could be also be a possibility of how he is recognizing it. Okay, so that could be also a possibility. So here it is questionable that Martin has sold this is questionable whether Martin has sold anything to the company, and hence detailed audit procedures will need to be performed to determine the existence of an asset in relation to the designs which have been sold to the company. Okay, anything to the company. So it is whether they have sold anything to a company, and whether in addition to this, whether the designs have been sold to the company or not should also be considered. They could possibly relate to assets such as patents, or some kind of intellectual property, but both the existence and valuation of such assets need to be supported by appropriate documentation. So we need to have appropriate documentation from Martin to say what is the valuation that he is bringing in. So you can also mention that Martin will need to provide okay, I'll put it as evidence to substantiate the valuation of the investment property and the existence of the investment property, else it could be deemed as fake and considered a fraudulent transaction. Hence, the audit team has to maintain high professional skepticism and investigate these transactions in detail. Okay, so hence this is a significant risk that the intangible assets are overstated by material amount. Further, there is also a risk that $10 million opening balance of intangible assets is overstated, specifically given that this is a new audit client. Okay, so Martin would have done similar transactions in the past, resulting in intangible assets being overstated and setting up to a fraud risk. So this is a very serious issue and this have to be very significantly considered. So here we need to write about the related party transaction, and as per what we have identified, the sale of the designs is considered to be a related party transaction. So we can mention that the sale of designs by Martin company by Martin to Gruber company is a related party transaction as per, so I put it as related party transaction as per IAS 24 related party disclosures. A related party Martin Gruber, okay, I'll put it as Martin who is a major shareholder and CEO of Gruber company will be defined as a related party, as per IAS 24, and the sale of designs will be a RPT transaction defined within the provisions of IAS 24. Transfer of resources, services or obligations between related party regardless of whether the price is charged. Okay, so hence in this case there is, so we can mention this, there is, okay, a risk that disclosures of the transactions is not made as per the IAS 24. Therefore which requires, okay, 24, which requires if there have been transactions between related parties, there should be disclosure regarding the nature of the related party relationship as well as information about the transactions and outstanding balances where necessary. Okay, so this is what we need to write. So we are saying that this is a related party transaction, and hence as per the related party transaction the proper disclosures have to be made, and there is a risk that the disclosures is not made according to the related party transactions and enough information is not presented and outstanding balances are not presented very well in the financial statement. This is the risk. Okay, so these are the audit risks that we have identified. Now let's quickly conclude conclusions about significant risk, significant audit risk. Okay, revenue recognition and intangible assets are likely to be considered as the most significant risk. Further, okay, further, the related party transaction due to the intangible assets could also be considered as a significant risk. Further, the considering the influence across the reporting process, the impact of management bias cannot be ignored. So this can also not be ignored. So these are the situations that we need to write. So we have done with A and B. So for 26 marks we have written. Now let's look at the next requirement, which is audit procedures for Nakatomi building. Okay, Nakatomi building. So whenever you are writing about the audit procedure, you need to think about the assertions. So this is an investment property. So investment property, the assertions, main assertions are value. I'm just writing it as a notes. Okay, you don't need to write this. Valuation, existence. Okay, you can also write more than classification. There will be rights and obligation. Rights and obligation, presentation and disclosure. Okay, so these are the major assertions that would impact. Valuation could include accuracy as well. So when it comes to rights and obligations, then we can ask for title deeds to see who owns the property, etc. Presentation, we need to check whether they are presented correctly as per IAS 40, IAS 40 investment property, which means we can check whether all the investment property are held at fair value, because they're saying their valuation is used. So whether they are following all the same standard for all the investment property. Other investment properties, if they have, are they following the same fair valuation model? We can see how they are valuing it. Are they valuing the fair value, presented it correctly, and ensure that we can ask for the rental agreement if they have given out for rental, to see whether it's not an owner occupied property. If it is owner occupied property, it has to be IAS 16. It cannot be IAS 40. So if it is rented out to someone third party, then it can be as per IAS 40. So those things we need to check. And when it comes to valuation, we can check the value of the property by using the expert. So we can check whether the expert and expert's competence, skills, and all those things have independence have to be checked. We can review the workings of the valuer to see how they are coming up with the valuation. They have paid for this, so we can check the 15 million cash statement that they have already paid, so the cash statement can be verified. Board minutes we can review for rights and obligations, and title deeds also we can verify for rights and obligations. Existence we can do a physical inspection. So these are the pointers or items we need to think of. So now I'm going to write all these procedures. So let's quickly write these procedures. So firstly is review the board minutes for rationale and confirming the approval of purchase of this transaction. Okay, that's the first one. Then you can write agree the $15 million paid to the company paid by verifying it against the cash book and bank statements, okay, to ensure valuation and existence. Okay, then you can write agree the carrying amount of the property to Gruber's non-current asset register to confirm the initial value has been recorded correctly. Okay, then you can say review the you can say inspect the title deeds, okay, legal documents to confirm the ownership of the building, to verify rights and obligations. Okay, then you can say physically inspect the building to review the existence and occupancy of the building by retail establishments to confirm the property has been appropriately classified as investment property. Okay, then you can then say also you can obtain and inspect rental agreements for the retailers who occupy the Nakatomi building to confirm that the property is not owner occupied and that it generates rental income to verify classification. Okay, that is also there. Then you can also check whether inquire with the management. So inquire with the management, all right, whether it holds other investment property and confirm if they are valued at fair value to verify the consistency of accounting policy applied. Then valuation, you can review the expert. So with regard to the expert appointed, by the management, we need to review the competence, capability, independence and the assumptions used by the expert to arrive at the valuation. Further, we can write obtain information to confirm the experience and qualifications held by the expert, like registration certificate with a professional body. Confirm the independence. Okay, so this is very important, because the expert should not be, the management expert should not be the known person to the management. So confirm the independence of the expert with Gruber company and its management team. Then review, okay, the assumptions used by the expert by inquiring with the expert, and also agreeing the valuation method in accordance is in accordance with IFRS requirements and can be applied. Okay, so we need to check the assumptions and whether the assumptions are in accordance with the IFRS requirements and there are no deviations or not. That we need to check. So obtain the final report. You can then say obtain the final report issued by the expert and review the calculations, methods and conclusions reached by the expert are in line with the auditor's understanding of the business. Okay, and confirm the valuation is recognized in financial statements and investigate any discrepancies. Okay, and then you can say the confirm the valuation has been carried out at the reporting date and is in accordance with the company's accounting policy. Okay, then reperform the valuation in the experts working papers. So these are the procedures we can write when it comes to the audit procedures for the Nakatomi building, which is an investment property as per IAS 40. Okay, so now let's look at the last one, which is discuss the ethical issues recommended by actions taken by our firm, which is in Exhibit 5, using the information in Exhibit 5. So let's read the Exhibit 5. A meeting took place yesterday in the audit engagement partner potential sale of Martins Gruber shares with the directors. The company directors reveal that Willis Company is the company with whom negotiations have been shared in relation to the sale of shares. Willis is an existing audit client of McClane Company. The directors have requested that McClane Company assist them with the sale by performing a vendor's due diligence, in which they would conduct an independent review of Gruber financial position and further prospects and produce a report on their management findings to provided to the Willis Company. So here this is a problem. Okay, I'll tell you what are the problems. I'm not going to explain in detail, but rather I'm just going to give certain ideas about the same. So here, ethical issues. Okay, if you consider the ethical issue, the first ethical issue this particular problem raises is the first ethical issue this problem Okay, the first ethical issue this problem raises is of conflict of interest. Okay, why? Because why it raises a conflict of interest? Because McClane company, okay, because McClane is an existing audit client, and Willis company, who is purchasing the shares, are also the audit client of, sorry, not McClane company, Gruber company. So Gruber company is an audit client, and Willis company is also an existing audit client of McClane company. Right? McClane and Co. So now this will create conflict of interest. Why? Because if we perform this valuation services, if we say Gruber company's valuation is good, okay, if we say Gruber company's valuation is really good, then Willis company will have to pay a good high price. So Willis company will not be happy with us, because Willis company will be saying to perform the due diligence and try to reduce the valuation of the company. Whereas Gruber company, who is a client, he will be saying perform the due diligence and increase the value of the company. So we will be working in conflict of both parties and risk and ask them both to confirm that they have. So we will be conflicting and working with the both interest against both the parties. Will want to purchase the shares at a lower price and Martins want to sell at a higher price. So hence there is a conflict of interest, as Will company wants to sell shares, wants to buy shares at lowest price, and Gruber wants to buy at highest price. So there will be a significant threat to objectivity, as one acting as for an interest of one person will be at the other person's expense. So acting for interest with one person will lead to other party lead to expense for the other. So this is the reason. Okay. So hence, how can we tackle this conflict of interest? We can ask the audit firm to provide confidentiality agreement with the team, or with its team members. Okay, both parties will have to be informed and make full disclosure. Okay, then both parties will have to give permission in writing, okay, for the services provided. So then also there could be breach of confidentiality as McClane is auditing Gruber, and McClane will have to hand over information to Wills, which could lead to breach of confidentiality. So hence that's the problem. Now how can we put the safeguard? What safeguards can we put? So safeguards is, okay, number one is to have separate teams to perform valuation and audit services. Both teams should sign confidentiality agreements and ensure there are no connections, no disclosure of information between them. Okay, and then we can have a appropriate reviewer not involved in providing either services to review the audit work performed and assess key judgments and conclusions. Okay, key judgment and conclusions. All right. You can also say an independent partner, second partner, to review the audit of Gruber company. These are the safeguards which we can apply. These are the safeguards which you can apply for the confidentiality. Now there is another risk which is involved. What is the other risk? The other risk is, I would put it as, self-review threat. Why? Because the self-review threat is because firstly, we are providing such services. When we are providing such services, it could result in firm assuming management responsibility. So we are the auditors and we are providing valuation services. So the valuation of the company's shares, which will be used in the company's financial statement, will again further will be audited by our company itself. So the valuation of the shares and equity of the company can be reported in the financial statements. Alright, will be reported in the financial statements, then which could lead to situation that are and the same will be audited by McClane, which could leading to self-review threat. Now, as this self-review threat will lead to lack of objectivity, as the audit team may lack professional skepticism and over rely on the valuation performed by their colleagues. Okay. So this is the self-review threat that I have been talking about. So firstly, conflict of interest arises. Secondly, there will be self-interest threat because providing such service, we are assuming management responsibility and we are doing the valuation which will be reported in financial statement. Then it will lead to lack of objectivity. So how can we safeguard it? So we can safeguard. Safeguards. How we can safeguard? So we can firstly use separate independent teams to perform the valuation and audit of Will's company. Having an independent second partner to review the audit of Will's company. Okay, so these are the situations. So we have to have separate teams to perform the review of our Gruber company, as well as separate team to perform the valuation of Gruber company. Same way, separate team to perform valuation of Gruber and audit of Will's company. Separate team to perform the audit of Will's company. The code also suggests that there will be a lot of subjectivity of judgment and involved. So when it comes to valuation, and therefore should consider before accepting this particular role. Okay, and then finally you have to conclude. Okay, you have to conclude the briefing note. So there have to be a conclusion of briefing note. Now what conclusion we should say? These briefing notes have evaluated what all your requirements. All your requirements you need to write. So whatever requirements you have been asked, all of them have been, you have to write it. Evaluated. Your requirements are firstly okay, evaluated. So the requirements, okay, and you have to write the requirements 1, 2, 3 and 4. Okay, so the requirements 1, 2, 3 and 4 have to be written down very clearly as a conclusion. And and you also need to suggest that it is unlikely that McClane can provide the vendor due diligence services as Gruber Co. To Gruber Co. as there is a conflict of interest. You should write the significant risk, what all you have concluded. So you can maybe start off with the first one, that is planning. You can maybe start off with the requirement immediately with significant risk. So I would put it as significant risk is revenue. Okay, revenue, investment property and related party transactions. Okay, and there have to be focused on management bias as well. There have to be focused on the management bias as well. Ethical codes should be considered, and unlikely that vendor due diligence can be provided. Okay, so those things you have to mention.